Hello, everyone, and welcome back for those of you who tuned in to my previous podcasts and webinars, all related to the COVID-19 pandemic. I'm Rick Buczynski. I'm Chief Economist at IBISWorld. Although these presentations are primarily geared towards supporting IBISWorld's hundreds of commercial banking clients, I would think that folks in other sectors might find some value in these. Today is episode 6, which is a continuation of last week's 2 webinars. So again, the theme will be focusing on several industries that are not well positioned for recovery after the crisis gradually fades, with, of course, some notable exceptions when compared to previous cycles. As a refresher, I employed several IBISWorld historically based metrics to help in this assessment. The first is an industry volatility metric. The second is a risk trend prior to the COVID-19 crisis. And finally, the third is a calculation of the compound annual industry revenue growth rate during the last cycle. That's the 2007 to 2010 period. And like previous webinars, there's a huge amount of data here. So take a closer look. As a point of reference, here are the industry groups I analyzed so far by episode. I'm providing this for those of you that may have a specific interest, so you can look back at the data I compiled and listen to my observations. Feel free to pause here. Like I did in last week's adventure, let me introduce some Bureau of Economic Analysis data, this time being the industries that are historically in the better half of the bunch. These are the ones that did pretty well during past recoveries. So here, the middle column shows the average peak to trough in industry value added for the 11 recessions since 1948. The compound annual growth rate of revenue from the previous cycle appears in the right-hand column. This is very useful stuff in both comparing and contrasting the current situation from those in past cycles. In what follows today, I'll explore 8 industry groupings: chemicals, mining, forestry, paper products, utilities, transportation, equipment manufacturing, miscellaneous real estate like commercial property leasing, and admin support services. Those are the sourcing out businesses. So let's start with chemical products. Here's a short list of those that have a very high risk intensity based on our historical metrics. Many like petrochemicals, dye, pigment, and fertilizer. Pesticides rank as being highly volatile. My point here: volatile industries can morph from being solid to in crisis mode virtually overnight. Volatility, as I've mentioned in previous presentations, is statistically linked to the probability of defaults. Scary stuff. By the way, dye, pigment, and fertilizer manufacturers are equally challenged by high exposures to trade, so-called import substitution. As I discussed in my May 5th webinar, these are all intermediate products that are vulnerable to the health of the manufacturing industries to which they sell. Therefore, this year's free fall in the Industrial Production Index for manufacturing goods doesn't bode well. The index was already on shaky ground last year. Well, mining has lost its luster in many areas. Like chemical products, it is a key intermediate good for many manufacturers, so sagging demand and a rapidly eroding industrial production index are indeed red flags. And like many commodities, mining and related activities are extremely volatile. Plus, they are exposed to international trade pressures. There's a lot of factors here that look like a perfect storm. For this group, IBISWorld's early warning forward industry risk rating is quite nasty for the next couple of years. Finally, don't forget that coal mining has been on the decline for many years, and its near-term future will clearly hinge on the November elections. The forestry industry is not particularly well positioned for a quick rebound. At best, it's uncertain. Housing starts will drive the logging industry, and the outlook for residential construction is highly uncertain. It depends on regional as well as national factors. The quandary is that low mortgage rates may be largely offset by rising unemployment and eroding household incomes. And the logging industry and forestry support services are joined at the hip. What about paper products? Paper mills and office stationery manufacturers live in a very volatile world. And general paper product makers that include a variety of products like playing cards, wrapping paper, filters, cups and dishes, egg cartons, etc., are heavily exposed to overseas imports. Once again, our early warning industry risk scores for these businesses are pretty pessimistic through 2021. Oh, there appears to be a well-documented exception here: sanitary paper product manufacturing. Consider utilities. They are reeling. Here's a short list of those that aren't positioned well at this juncture. Energy consumption is very much tied to economic activity, so the outlook is dicey. It depends in part on the shape of the recovery, the U, V, L, or W shapes that I discussed in my previous webinar. But many were experiencing increased risk prior to the COVID-19 crisis as the economy was slowing. The rub is that the COVID crisis could thrust unpaid utility bills to the highest level in decades. With millions and millions of people out of work, many utilities have stopped disconnecting customers for failing to pay their bills. Sagging manufacturing doesn't help. Working from home doesn't either. Also, electric power transmission companies are in the same boat. Exelon, a major player, has downgraded its 2020 earnings guidance due to the impact of the virus. Let's turn to transportation equipment manufacturing. Not surprising, these four are at the upper end of the industry risk intensity index. Many in the highly volatile category, and American motorcycle, bike, and parts manufacturers are being compromised by import penetration, another risk. Train, subway, and transit car manufacturing are also high risk going forward, according to IBISWorld's early warning system. Not on this list are aircraft, engine, and parts manufacturing and shipbuilding. Going forward, they should be. Let's finish off with a couple of industry segments where many commercial banks have significant loan exposures. One is the BEA Other real estate group, where several NAICS industries look very weak. Check out the table. Real estate sales and brokerage firms and real estate asset management companies reside in a notoriously volatile, at times boom or bust world. And property management companies' performance during the previous cycle doesn't suggest a rapid turnaround down the road. The future of commercial leasing is especially worrisome given work-at-home trends that may accelerate over time. Finally, let's take a peek at some key administrative support services. These are often defined as businesses that are sourced into by larger firms. There are more exceptions here than what our historical indicators might suggest. So these define a clear departure from the past. So take note. Let's think about these exceptions. In the very high risk intensity category, debt collection agencies and credit bureaus and rating agencies may indeed fare much better than they did during the last cycle. It's common sense. While the four industries listed here under medium risk intensity aren't likely to rebound robustly in sharp contrast to past economic cycles. Take a look. Again, it's common sense. Well, I'll finish off this theme later in the week, so please check it out. In the meantime, stay safe and Godspeed.